Welcome to the Lever Trades podcast, where we take a deep dive into both foundation and advanced educational trading concepts. This video is not intended to provide investment advice. All content and opinions shared are for informational and educational purposes only. Trade at your own risk. Okay, so we're hearing a lot these days about bond ETFs, right?
Yeah.
And how maybe they aren't acting like everyone thought they would.
Right.
Well, with interest rates going kind of crazy.
Yeah.
So today, let's do a deep dive into bond ETFs.
Okay.
We'll unpack how they actually work and why rising interest rates seem to be messing with them so much.
That sounds good.
You know, it's funny.
What's that?
Everyone always says bonds are supposed to be like the safe and reliable investment.
Right. Like the steady one in your portfolio.
Exactly. You just sit back and watch your money grow.
Right. Like that old car that just keeps chugging along. You know?
Totally. But lately, with interest rates going all over the place, it's more like everyone's on a roller coaster.
Yeah. A lot of people are getting thrown for a loop with this.
Especially with that whole thing about how when interest rates go up, bond prices go down.
Right.
That part always makes my head spin a little.
Yeah. It seems a bit backwards at first.
It does.
Think of it this way.
Okay.
Imagine you've got a bond and it's paying you 3% interest.
Okay. 3%. Okay. Got it.
Then suddenly brand new bonds come onto the market and they're offering 4%.
So yours isn't as good anymore.
Exactly. Suddenly yours isn't so special.
I'd want that 4% bond.
Exactly. Everyone wants the best deal, right?
Right.
So to make that older 3% bond attractive again, the price has to drop.
Makes sense. Gotta stay competitive.
Exactly. It's all about keeping those yields attractive to investors.
Okay. That makes sense. And our source material actually has this really helpful table.
Oh, yeah.
Yeah, it shows exactly how this works when interest rates fall. Those older bonds with their higher locked-in rates become really valuable.
Because everyone wants that higher yield.
Exactly. So their prices go up.
Right. So it's like this constant dance between interest rates and bond prices.
A dance where they're doing opposite moves.
Pretty much. And that's really the key to understanding why your bond ETFs might be acting up right now.
Because it's not just one single bond. Right?
No, it's way more than that.
It's like a whole bunch of them bundled together.
Exactly. Bond ETFs aren't like buying a single bond from a company or the government. They hold a whole bunch of different bonds all mixed together in one package.
So when interest rates go up, like they have been, the value of that whole basket of bonds can go down.
Exactly. It's like the whole basket is on a seesaw with interest rates.
And to make things even more interesting, bond ETFs are traded on the stock market, right?
They are.
So their prices can change all the time.
Exactly. That's where things get a little more complicated because they're traded throughout the day just like stocks.
Oh, wow.
Yeah, their prices can swing around more than individual bonds would.
So they're more liquid.
Yes, you can buy and sell them easily.
But that also means they're more sensitive to like the market's mood swings.
Precisely. More freedom, more risk.
So it's like they're trying to be the best of both worlds.
In a way, yes.
A calm, predictable bond and a quick reacting stock.
And that makes them a bit hard to pin down sometimes.
I bet. And then there's the whole thing about how you measure a bond ETF's yield. There are so many different ways to calculate it.
There are a lot of different methods.
Like average yield to maturity and the SEC 30-day yield.
Yeah, those are some of the most common ones.
And none of them are perfect, right?
No, they all have their limitations.
But they give you an idea at least.
They give you some insight into the potential earnings.
Okay, so it sounds like we've got all these moving parts with bond ETFs.
We do.
Interest rate changes, a whole bunch of bonds bundled together, and daily trading.
It's a lot to keep track of.
No wonder some people are feeling lost.
I know it's a lot to digest, but the important thing to remember is that with bond ETFs, you can't just set them and forget them.
Right, they're not totally hands-off.
No, they're not. They can lose value just like any other investment, especially when interest rates are volatile.
Okay, so you really need to understand what you're getting into.
Exactly. Knowing how those yields are calculated and what types of bonds are in the ETF can make a big difference.
So let's say you log into your account and your bond ETF is down.
Uh-oh.
What should you do?
Well, before you hit the panic button, let's look at why selling might not be the best move right now and what other options you might have.
It's kind of like when you're on that roller coaster and you're going up that really big hill.
Oh, yeah.
And you're like, oh, man, I don't know about this.
Right.
But then you remember the whole point is to ride the whole thing.
Exactly. You got to embrace the ups and downs.
Otherwise, what's the point, right?
That's investing for you. It's a roller coaster, not a lazy river.
So true. But seeing those numbers in the red can be scary.
Oh, absolutely. It's natural to feel that way.
Especially if you thought bonds were supposed to be the safer option.
Yeah, that's why it's so important to remember that this is a long game.
Okay, So patience is key.
Patience is key. Don't let those short-term dips freak you out.
Write it out.
Write it out. Because remember, those interest rates, they always move in cycles.
So what goes up?
Must come down.
Eventually.
Exactly.
Yeah.
And when those interest rates stabilize or even start going down your bond ETFs, they're going to be ready.
Back on the upswing.
Exactly. They'll be well positioned for a rebound.
Okay, that's good to hear. But while we wait for the roller coaster to even out,
Yeah.
our source material mentioned some other ways to maybe earn some income in the meantime,
Oh, absolutely. There are always other options to explore.
like detours on our investing adventure.
I like that. And you know, some of those detours, they start looking pretty good when interest rates are high.
Oh, yeah? Like what?
Well, take money market accounts, for example, or MMAs, as they're called.
MMAs, okay.
So with MMAs, you can access your money really easily. It's very liquid,
Okay, so it's accessible.
very accessible.
Yeah.
And the interest rates they offer, those go up along with those rising Fed rates.
So you're earning more interest without having your money locked away somewhere.
Exactly. Unlike a certificate of deposit, for example.
Right, with a CD, your money is stuck there for a while.
Exactly. CDs usually have a higher yield than MMAs, but there's a catch.
Got to keep that money there.
Yeah, you commit to a fixed term, and if you take your money out early, well,
You get penalized. So it's like weighing your options. Do you need the money now, or do you want to potentially earn a bit more?
exactly. It's all about trade-offs, right?
Always. And then there are high-yield savings accounts.
Ah, yes, those are the rock stars of the savings world these
They
days.
sound fancy.
They offer better interest rates than your typical savings account.
Nice. So many choices.
That's the thing about investing. There are so many different paths you can take.
But I guess the key is figuring out which one matches your own personal goals.
You got it. What are you hoping to achieve with your money? And how much risk are you comfortable with?
Because there's no one right answer for everyone.
Exactly. It's all about finding the right fit for your own personal situation.
And that's why we love these deep dives.
Me too.
Breaking it all down so everyone can make those informed decisions.
Knowledge is power.
Right. And speaking of knowledge, something that stuck out to me in the source material was the part about how bond ETFs don't have those same maturity guarantees
Oh, right. Yeah.
like you get with individual bonds.
Yeah, that's a key difference.
Can you explain that a bit more? So with individual bonds, it's like loaning money, right?
Yeah, you lend it out for a set amount of time.
And, you'll get it back when the bond matures.
Exactly. At maturity, you get your principal back.
Well, with bond ETFs, it's like that maturity date is kind of fuzzy.
Well, it's not that it's fuzzy. It's more like there isn't one specific maturity date for the whole ETF.
Oh, okay.
Because remember, a bond ETF holds lots of different bonds with different maturities.
Right. It's a whole basket of them.
Exactly. And they're constantly buying and selling bonds to keep the overall mix just right.
So it's like a juggling act?
In a way, yes. They have this thing called a target duration.
Target duration.
Yeah, it basically means they aim for a specific average maturity for all the bonds in the ETF.
So they might sell some bonds that are about to mature.
Exactly. And then they'll use that money to buy new bonds that mature further out.
To keep that balance going.
Exactly. So you don't have that one single maturity date like you would with a single bond.
But you also don't have to worry about reinvesting the money when it matures.
Right. The ETF manager takes care of all that for you.
So less control, but maybe less work too.
I guess you could say that. It's all about what you're looking for in an investment.
And understanding those trade-offs.
Exactly. And this is where doing your research really pays off.
Because you need to know what you're buying into.
Absolutely. Bond ETFs can be a good tool.
But they're not a magic solution.
No, they're not. Don't just assume that anything with the word bond in it is a guaranteed win.
Right. Especially with all the different opinions out there.
I know, it's like everyone's got something to say about bond ETFs.
They're good, they're bad, they're confusing.
Right. It's enough to make your head spin.
It really is. So I think the takeaway here is to block out the noise,
And focus on what's important.
which is
Understanding the basics. How do bond prices work? What are the ins and outs of ETFs? What are you actually trying to accomplish with your investments?
I like it. Back to basics.
Always a good starting point.
And speaking of starting points,
Yeah.
you mentioned earlier that the biggest bond ETF in the U.S. is over $115 billion in assets.
It's a staggering amount of money.
It really is. And it makes you wonder if so many people are still invested in bond ETFs.
Even with all the ups and downs.
Maybe they know something we don't.
Or maybe it just shows that despite the volatility, there's still a huge demand for bonds.
Like they're the main course, even if the side dishes are a bit questionable at the moment.
That's an interesting way to put it. But it highlights the fact that investor behavior can be just as important as the numbers themselves.
Because all that money moving around, that's
Right.
what really drives the markets,
Precisely. And it creates a fascinating feedback loop.
where sentiment can shape reality.
Exactly. Which leads us to our final thought for today.
The one we leave you pondering,
We've talked a lot about the mechanics of bond ETFs, right?
how it all works.
But what happens if that sentiment shifts?
If all those investors in that massive bond ETFs suddenly decide to sell,
What happens to all those billions of dollars?
where does it go?
And what kind of ripple effects might we see throughout the market?
Big questions.
Big questions with no easy answers.
That's investing for you, always keeping us on our toes.
Always.
Well, that was a wild ride through the world of bond ETFs.
A roller coaster indeed.
Hopefully you all feel a little more equipped to navigate it now.
That's the goal.
Thanks for joining us today for another deep dive.
Anytime, it's been a pleasure.
We'll see you next time.